Why are surety bonds required on public projects? This is to protect the taxpayers' money. Along the same lines, why should banks require bonds on private commercial projects? Well, it's to protect the lender's money.
Merchants Bonding Company joins the Surety and Fidelity Association of America in educating construction lenders about the benefits of surety bonding. A surety bond is a three-party agreement that assures the obligee or owner that the contractor or principal will perform a construction contract. A surety bond will also ensure contract completion in the event of contractor default. A surety is generally introduced to a contractor through an agent partner. Together, the parties will serve the account. A lender can become involved through a rider, referred to as a dual obligee rider. This allows an additional obligee or beneficiary to be added to the bond, enabling the lender to invoke the bond benefits. There are three types of contract surety bonds. A bid bond, which assures the contractor's bid was submitted in good faith and that they intend to provide the required performance and payment bonds to execute the project. A performance bond, which assures the obligee that the principal will perform the contract. And a payment bond, which ensures the owner that the contractor will pay subcontractors, laborers, and suppliers associated with the project. Contractor default is preventable. The surety spends ample time evaluating the contractor and conducting an in-depth look at the contractor's entire business operation. The surety's pre-qualification assessment can be broken down into the three C's: capital, the contractor's financial strength; capacity, the contractor's ability to perform the contract; and character, the contractor's reputation.
The reason we're in business is because construction is a risky business and contractors do fail. We've broken it down into two different categories, internal and external.
Internal causes of contractor failure may include new geographic territory unknown to the contractor, new lines of construction taken on, a large jump in job size, disputes on a job, lack of formal continuity plan, and personal issues encountered during a project. External causes may include the state of the economy, poor weather conditions and acts of God, incomplete architectural plans, and default of a subcontractor during a project.
So what are the benefits to the lenders? Simply put, is to protect the value of the lender's collateral, okay? So the value of the collateral taken to secure the loan, it's at risk if the performance of the construction contract is at risk.
By securing a surety bond, lenders can benefit from a surety's pre-qualification process, ensuring a contractor, in the surety's estimation, is capable of performing the work and meeting its payment obligations. When a payment bond is in place, subcontractors can seek financial recovery by filing a claim on the property. A surety will also investigate, evaluate, and mediate disputes between the owner and the general contractor. When a lender is added as a dual obligee rider to the principal's performance and payment bonds, the lender will receive direct rights against the surety bond as long as the lender continues financing the project. A surety can provide unseen benefits in response to contractor failure. In example 1, construction begins on a $4 million new mini-mall bank and drugstore joint venture in June 2008. Funds were advanced and secured by a first mortgage, with completion dates set for May and July of 2009. In the spring of 2009, Merchants confirms the project is 30 days behind schedule and that the subcontractors and suppliers are not being paid. The obligee informs Merchants that termination of the project is pending due to disputed change orders, subcontractors abandoning the project, and financial difficulties of the principal. As a surety, Merchants steps in, deciding to keep the current contractor on the project and to provide the necessary funds to complete the work.
Without the surety's involvement, the number of days delayed would have been that much higher, and the damages suffered by the private joint venture and their lending institution would have been very extreme.
Overall, Merchants spent $800,000 in expenses to complete a $4 million project. The project was completed and avoided abandonment, delays and damages were minimized, and no encumbering liens and litigation were presented. In example 2, construction begins in September 2010 on a plaza redevelopment, including a $5.6 million food co-op and a $3.5 million housing limited partnership. Funds were advanced and secured by a first mortgage. By fall of 2012, both obligees informed Merchants the principal is no longer able to complete both sections of the project. The project is 95% complete, Therefore, substantial completion has been met. Shortly after, the obligees terminate the principal. As the surety, merchant steps in and hires a construction consultant to act as the general contractor in place of the principal.
Due to our monitoring of the file and having a plan in place to deal with the termination, the businesses associated with this building were able to operate and continue in business.
Overall, merchants spent $1.3 million in expenses to complete a $9 million project. Both sections of the project were completed. There was no bank foreclosure, liens were released, and delays were minimized.
Requiring surety bonds from principals on bank finance projects is an effective and economical way to protect the bank, your loan, and the obligee. And the pre-qualification of principals by surety companies assures a well-qualified contractor and the payment of subs and suppliers.
Surety bonds offer several benefits to commercial lenders. For more information and questions, please contact us at merchantsbonding.com.